If you're staking crypto, you've probably run into one of the biggest, most confusing tax questions out there. How in the world do you classify your staking rewards? And look, this isn't just some academic debate. The answer can have a huge impact on your wallet. So in this deep dive, we're going to walk through the technical analysis to find a clear, definitive answer. So here it is. This is the core dilemma. For years, crypto investors have been stuck in this gray area, wondering, am my reward simple interest, like from a savings account? Or am I technically running a business that owes a whole other layer of tax? The stakes are incredibly high and the confusion is real. Let's clear it up one logical step at a time. So to get to the bottom of this, we're going to follow a very precise legal roadmap. First, we'll lay out the problem. Then, we'll figure out when your rewards even become taxable, based on a really important IRS ruling. After that, we'll figure out what kind of income it is, and finally, we'll apply a crucial legal test to see who owes self-employment tax, which will lead us straight to the correct way to report it. All right, let's start by understanding exactly what's at stake here. This isn't just about which little box you check on your tax return. It's about a potential 15.3% tax hit.
Okay, so the whole conflict really boils down to these two tax forms. Whether you report on Schedule B for interest or Schedule C for business income, you're paying your ordinary income tax rate. But Schedule C comes with a kicker, the self-employment tax. That's an extra 15.3% right off the top to cover Social Security and Medicare. Getting this wrong can be a really expensive mistake.
Now, to classify this income correctly, we have to understand what's actually happening under the hood. Proof of stake is not like lending money to a bank. You are actively performing a service to secure a network. Your rewards depend entirely on your validator's performance, and if they mess up, you can actually lose your principal. That's called slashing. This element of performance and risk is the crucial legal difference that separates staking from a simple loan. So before we can even figure out what kind of income this is, we have to know when it officially becomes income in the eyes of the IRS. And that brings us to the foundational IRS ruling that really governs this entire discussion. In July of 2023, the IRS gave us Revenue Ruling 2023-14. Honestly, this is the single most important piece of guidance we have on this topic. It directly tells us when a taxpayer has to recognize staking rewards as income. Pretty much everything we're about to talk about flows directly from this ruling. So how did the IRS come to its conclusion? Well, they went way back to this landmark 1955 Supreme Court case, Commissioner v. Glenshaw Glass. This case established the definition of income. It exists when you have a clear increase in your wealth that you have complete dominion over. That phrase, complete dominion, is everything. And this is what dominion and control actually means in practice. It's not when you sell the rewards, it's the moment you can sell them. The second you have the ability to transfer, trade, or do anything else with your rewards, even if they're just sitting in your wallet, you have dominion and control. And at that exact moment, it becomes taxable income. Let's just walk through the life cycle here. Locking up your tokens to stake, not a taxable event. While your rewards are piling up, if they're locked and you can't touch them, still no income. The taxable event, the moment the IRS tax clock starts ticking, is step 3. The exact instant those rewards are unlocked and available to you. That's when you report their fair market value as income. Selling them later, that's a totally separate event that triggers a capital gain or loss. And this is so critical. The IRS, with this ruling, has definitively shot down a popular argument from the Jarrett case. You might have heard of it, the created property theory, where you don't owe tax until you sell the asset. The IRS has made its position crystal clear. Income is recognized when you get it, not when you sell it. Trying to follow that old theory now comes with some serious audit risk. Okay, so now that we know when it's income, we can finally tackle the main event. What kind of income is it? Let's start by dismantling the very common idea that staking rewards are interest, a myth that's been fueled by exchanges advertising flashy APYs. The law is actually incredibly specific about what counts as interest. The Supreme Court, in cases like Deputy v. DuPont, has defined it as payment for the use of money. That means there has to be a loan, a formal debtor-creditor relationship, where one party clearly owes the other money. And this comparison just makes the difference crystal clear. With native staking, you are performing a service by securing a network. Your rewards are based on performance, and you can actually lose your principal. That is fundamentally different from a lending agreement where you just give someone money and expect it back from a well-defined debtor. Legally, these are two completely different things. Hey, and don't just take my word for it, just look at the tax forms the exchanges send out. Big players like Coinbase issue a Form 1099 MISC for other income when you get staking rewards. But for their actual lending products, they issue a 1099 INT for interest. This is a massive signal from their legal departments. They know staking is not interest. So, if it's not interest, it's other income. Now we have to answer the final and most critical question. Is it income from a trade or business? This is the test that determines whether you owe that extra 15.3% self-employment tax or not.
The legal standard for this comes from another Supreme Court case, Commissioner v. Groetzinger. To be considered a trade or business, your activity has to meet a two-part test. First, you have to be involved with continuity and regularity. It can't just be a passive, once-in-a-while thing. And second, your primary motivation has to be for income or profit.
Now for the fun part. Let's apply this Groetzinger test to the two main ways people stake crypto, by delegating their coins to someone else or by running their own validator node. As you're about to see, the tax outcomes are polar opposites. This slide breaks it down perfectly. A delegator's activity is usually just set it and forget it. It doesn't have that continuity and regularity the tax requires. In fact, another Supreme Court case, Higgins v. Commissioner, ruled that just managing your own investments isn't a business, no matter how much you do it. But a validator operator, that's a completely different story. They're actively managing hardware and software 24/7 for profit. That absolutely is a trade or business. Okay, we have gone through the timing, the character, and the business test. Now let's pull it all together into a final, actionable conclusion on exactly how you should be reporting this income. This table right here is the ultimate cheat sheet. For the vast majority of people, those of you who are delegating your stake, that income goes on Schedule 1 as other income, and critically, no self-employment tax. Now, if you're running a validator, that's business income. It goes on Schedule C, and yes, you owe self-employment tax. And for those few true lending products, that's simple interest on Schedule B. So, let's just state the main takeaway from most of you watching this. Your staking rewards are other income. You report them on Schedule 1, Line 8Z. You'll pay ordinary income tax on them, but you are not on the hook for that extra 15.3% self-employment tax.
So we've answered the big, complicated question of classification. But solving that puzzle leads us to an equally important practical challenge. Knowing where to report the income is only half the battle. Being able to prove the numbers is the other half.
And this is the final crucial takeaway. According to the IRS rules, for every single reward you receive, and I mean every single one, you have to document its fair market value at the precise moment you gain control of it. This value is not only your income for the year, it's also the cost basis for that specific coin when you go to sell it later. Without meticulous, time-stamped records, proper compliance is basically impossible. Thanks for watching.